Now we can start.
Okay. Hi, everybody. Thanks for joining in today. As we approach the end of calendar year 2025, I thought it is a good time for us all to get together, uh, candid reflection about our portfolio. How have Windmill Capital small cases performed during the year? What caused the performance? What has generally been happening in the world around us? Some back end changes that we have made from our end to make our processes easier and uh, 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 sort of improve our performance over a period of time. This is going to be a long term thing, and new small cases that we have launched and all of these things. So I just want to discuss all of these things with you guys. uh, so to start with, this is what the performance looks like. uh, we have and I am going a little behind 2025 and starting September 2024. I'll give you a context as to why I have done that. So to start with, our target date small cases have done exceptionally well. On an absolute basis, they've generated anywhere between 14.5 close to 15% to 23%. But at the same time, model small cases, pretty much everything is down. Worst performer is dividend stars model, down close to 19%, whereas a couple of other small cases like growth at fair price model and value and momentum model are down about 6%. Asset allocation models have performed slightly better. Of course, these are the small cases that are built on top of a pure equity model, and they keep pivoting into safer asset classes based on market volatility. And of course, as you can see, even in a bear market, they have managed to generate positive returns, which is what the intention of the small case is in the first place. Uh, Moving on, thematic small cases also not done so well. Smart beta ones are also slightly down. Trackers slightly mixed basket. Mahindra generated positive returns. HDFC was like huge positive. Bajaj and Tata have generated negative returns. Quantitative models have done really well. We launched two new quantitative baskets this year. Quality blue chips quant and growth multi-cap quant. Quality blue chips quant is we launched it in February. That's up close to 36% in a short span. Growth multi-cap also generating positive returns. Quality small cap quant also up 4.2%. So this is as far as the paid small cases of Windmill Capital is concerned. Now, sort of like, let's get a little bit of context, right? If we are talking about so much of negative returns, it is important to understand the context in which these negative returns have been generated, right? So let's take a look at the context. This is how the market has performed over the last 1 year. Once again, I've gone a little behind. I've started in September 2024, and I have pulled up the MSCI India Price Index and compared that with the MSCI Emerging Markets Price Index. So of course, you can see that MSCI India Price Index, which sort of gives you a flavor of how India has been performing as compared to emerging markets. India is down close to 8%, whereas emerging markets during the same period, that is between September 2024 till December 2025, they have generated close to 25% returns. So this is the background in which Windmill Capital small cases have not performed well. Very important for us to understand this, right? Okay. Now, what has caused this underperformance, right? Why is India down 8%? A couple of different factors contributing to this. First one, we started with high valuations. You can see the 27.9 over there. That was the valuation of Nifty 500 in September. And you can also see that, continuously since Jan 2022, this huge spike was when there was COVID and all of those things. Since Jan 2022, we were sort of on a secular uptrend. There was a little bit of correction in 23, but then we've generally been trending up. We were down in our 20s, and then we started trending up. It went up to 27, 28, which means we were significantly overvalued when compared to the history. And since then, we've been on a correction spree. So first thing, valuation, that is what is causing the underperformance. Second thing, generally there's been a corporate slowdown. How do we know that? There's been a slightly slowdown in corporate performance. If you sort of look at how brokers have started expecting the performance of corporate India to be, you have to take a look at this chart. So what I have done here is, let me just walk you through this. I have put up all the sectors, out of Nifty 500. Then I have checked to see what broker expectation was about performance 8 months ago, that is in April, regarding total revenue and net profit, and what it is today, right? And you can see that consistently there has been a downgrade, right? And this is across all the sectors. Financials, whatever was the expectation. If in April, brokers had estimated that, financials cumulatively will make about 100 rupees, they have downgraded it. They have said, okay, now they are going to make only 99 rupees. Similarly, net profit 100 rupees they expected financials companies to make. Now they're going to make only 99 rupees. Similarly, industrials 100 rupees they used to make. The expectation today is that, the top line is just going to be 96 rupees. Bottom line, further bad, like, there's a lot more pressure. It's just going to be 92 rupees. So this is the way you have to interpret this particular graph. And what you can see is, regardless of whether the sector is sort of like, domestic focus, like financials, consumer staples, healthcare, consumer discretionary, or they are external focus, like information technology, pretty much generally the outlook has been poor. Like, performance also has been pretty flattish. On top of that, broker estimates also have been matching that, right? And so overall equity outlook for FY26 has been tempered. And companies have also, like, we've just finished our second quarter rebalance and stuff like that. So company performance also has generally been pretty poor. So second factor contributing to the underperformance. Third factor, of course, you've all been following global news. There's all, like, there's this huge overhang of Trump tariffs on top of our head. There was a second round of large US tariffs that USA decided to impose on account of Russian oil imports. There's also been, like, significant policy statements around, like, increasing the cost of H-1B visas. So all of these factors have sort of, like, come in together. We've had like overvaluation, we've had, like, pretty flattish corporate performance. Then there has been global news. All of these factors have contributed to significant FPI outflow since September 2024, which is sort of what is dragging down the performance of India's equity markets. FPIs have sold close to, like, $24.6 billion on a net basis since September 2024. So all of these factors sort of, like, coming together to pull down the performance of stock markets. So one thing that we've consistently sort of, like, heard since the beginning of the year are, like, we've talked about how it is, how one can survive a bear market. And we've also heard about a lot of investors calling in, like, being very anxious about the performance of their portfolios. And there are a whole host of questions that they keep asking us about this. Right. So one of the factors, and I sort of collated all the questions that they keep asking us. And a lot of times we have to understand that these people don't really have a context. Like, they come in, they see a portfolio, and of course, like, because they are non-financial people, they don't check on, what is happening in global news and stuff like that. They don't follow that. And they're, of course, anxious that, their portfolio is not performing well. It is hard-earned money. That is understandable, right? So I sort of compiled all the questions that we keep getting. And this is, like, a general theme. Like, one question is, like, I invested last year. It's been more than a year. Why am I still in the negative? Second question is, see, the portfolio is down close to 20, 5%, 6%, 10%, 15%. Why are we not avoiding this fall? But, like, why are we letting it float the way it is floating? Third very common question that I have, like, sort of touched upon multiple times is, why are we not rebalancing and selling off all of these stocks? Like, that way we can sort of, like, cut down on our losses. Fourth question is, like, why not shift into some other asset class? Gold is performing very well. Why are we not shifting into other class? That particular asset class. Another question is, like, should I just sell off all my equities, and should I, now that you guys are not doing it, should I buy myself move into gold? Do something about the strategy. Why are you not tweaking the strategy and making sure that, we are generating positive returns? So these are sort of, like, the repeated queries we keep getting around, this bear market and performance of the baskets. Now, one thing that we have to understand is, first thing, there is a huge psychological play over here when it comes to bear markets, right? Human brains, they are built for survival and social conformity. We sort of, like, uh, we want to do what the herd does, and we want to ensure that, we want to do what everybody around us is doing, right? So this is sort of a little anathema when compared to long-term investing, because when it comes to long-term investing, there is a lot of times where you shouldn't be doing anything at all. And when the market is selling, you have to maintain your calm, you have to maintain your patience, and you sort of have to move away from that social conformity aspect of it and not jump in to take any action, right? but the exact opposite happens, because there is a angle of social conformity. You're doing a lot of herd based behavior. You are scared and you want to take some particular action as far as the small case or as far as the portfolio that you have invested in is concerned, right? So that is where the difference between a professional fund manager and a layman investor sort of comes in. Okay, now let me try to talk to you about a couple of behavioral traps that comes in when it comes to bear markets. First question or first behavior that we consistently see is, as soon as the market starts falling, there is a fear driven selling. The more the market falls, there seems to be more of this panic that sort of sets in. And we don't think about the strategy. We don't think about why we have invested in a particular small case or any other portfolio for that matter. We are just trying to, it is almost like, you're playing roulette, and the moment you start making losses, you want to get out of it. That is not the way stock market works, right? That is not the way it works at all. So that is the first trap. Second one, flight to safety. Try to keep shifting between asset classes. Equity is not doing well, sell out of equity and move into some other asset classes, because that temporarily is doing well. What happens the day it starts dropping or it is flattish? You try to sell out of that and move into equities. This sort of flight to safety also sort of kicks in. Herd mentality, following others into bad timing. There is some news driven selling that happens for a short bit. Everybody wants to follow the same thing, or you call in and say that this is what you should be doing. That sort of pressure gets created. Then fourth thing, short-term panic. There is a lot of emotional decision making, and this sort of overpowers long-term discipline. Right? These are some of the common behavioral traps that most investors go through, and we have to understand that equity investing is all about patience and discipline, right? Moving from one asset class to another asset class, starting to sell just because the markets have started hitting a bottom. All of these things, is not going to help at all. So what should be the takeaway, general? It is okay to feel emotions. It is all our hard-earned money that is getting invested in the market. Markets are not doing well, or the small case sort of tends to go down a little bit. It is okay to feel that fear. It is okay to feel that anxiety, because uh, we all come in with some goals in mind when it comes to investing, and when you feel that the returns of the small case will not help you achieve those goals, it is okay to feel those emotions. But at the same time, it is important to understand the context in which there is an underperformance, and why you shouldn't go out and act on that emotion. That is the first thing. Second thing, one has to think about this in cycles, right? This performance, one has to think about it in cycles. Now, I showed you historically what had happened between 2022 to 2024, what had really happened to sort of the PE ratio, right? There was a secular uptrend. Whatever correction you are seeing, we have to understand that for almost 2 years, right? Probably between Jan 2023 till March 2023 till September 2024, we've had an exceptional bull run where our returns have gotten doubled. So whatever sort of flattish performance that we've been seeing since September last year, it has to be placed in the context of the bull run that we've experienced, right? That is very important. So it is important to look at these returns, the performance of the strategy, etc., in cycles, and not just in terms of headlines. News channels will keep screaming that the market is down so and so, FPIs have left so and so, rupee has dropped so and so. It is important to not just look at the headlines and try to start acting based on that. It is important to understand that we are going through cycles. There was a bad cycle, there was a good cycle that we went through for a good 15, 17 months. Now there is a bad cycle that we are going through. Those good cycles will revert again. It is important to understand that. Last thing, it is extremely important that your time in the market, are you spending 3 years, 4 years, 5 years, 7 years? This time in the market is more important than attempting to time the market. Somehow there's always a focus for retail investors on attempting to time the market. Array, the stock is falling, we'll get out of it right now, we'll come into this when the time is good. There is absolutely no way that any fund manager or any portfolio manager will be able to manage those timings perfectly, right? And in trying to do that, selling when there is panic, buying when there is exuberance, there is a lot of brokerage charges and other costs that get involved. You will not get the timing right, and it is most likely that you will end up making losses rather than any kind of profit. Okay, so very important to understand that. Bottom line, It is not the bear markets that destroy wealth, right? If you had invested in value and momentum small case in September 2024, your wealth would have been flat, right? You would have from if you had invested 100 rupees, you would have come down to 94 rupees. Your wealth has not been destroyed, right? There's a little bit of a downturn, but your wealth has not been destroyed. But if you try to keep timing the market, what you will do is the losses are going to get exaggerated. It is very important to understand that, right? So please keep that in mind. Next thing is about how to use portfolios better, right? Now that we've talked about all the behavioral traps and stuff like that, it is important to understand a lot of times what is the focus that retail investors get in, but what is a slightly different focus there has to be as far as investing in any portfolio is concerned. I'm not just talking about small case, I'm talking about any portfolio, right? For most investors, what usually drives concern is what is the entry price of my stock? What happens to short-term swings that, am I feeling comfortable because of that or uncomfortable because of that? A couple of days ago, I had a very sort of um, a very ill-tempered call with an investor who was very unhappy that they had started investing in GEMQ model small case 1 month ago, and none of his stocks had returned positive returns, or the returns were not so great within just a matter of month. I tried explaining that 1 month is not really a time to judge anything at all. But a lot of times investors' mood seem to be set based on this, short-term swings, and how they are feeling based on that. And if in the first month you don't start seeing returns, then a lot of times people will come back and ask for refunds and stuff like that. The question is not about whether refunds have to be given here or not given here. The question is the amount of time that you are willing to stay invested, right? 1 month, 2 month, 3 month cannot be a benchmark or cannot be a time frame within anything can be judged as far as these strategies are concerned. Second, what matters for outcomes? Very important that you stay along with the portfolio design, right? Give the strategy the time it was built for. I'll give you an example. A lot of you have been investing in quality small cap quant small case. And the name itself says it is the focus here is small cap companies. What is the idea behind small cap companies? The idea is that small cap companies are you start investing in them on day zero, and then how it is going to go up, how these small cap companies are going to become large cap or mid caps over a period of time. That is not going to happen in a matter of 2 months, 3 months, 4 months, or 6 months, right? It takes years for something like that to happen. It takes years for the company to be able to double their profits. That's not going to happen within a period of mere months, right? So we have to give the strategy the time that it was built for, right? Attempting to rush through within a matter of months doesn't help at all. How to think about difficult phases? First, if there is a drop in the performance of the small case, if there is a drop down, that is certainly not an instruction for investors to act. Second, a fall is not a strategy failure. Like I showed you, markets have been falling, small cases will perform poorly. So, just because there is a fall, do not attempt to get out of the small case. Uh, Most importantly, don't attempt to time anything at all, right? Fourth, rebalancing enforces discipline, right? Even if your portfolio has gone through a loss, if you are trying to rebalance something, the idea is that we are trying to get out of, stocks that are not aligned with the strategy and get in more stocks that are, aligned with the strategy. So, do not hesitate to sell something that is in the loss when the portfolio manager is asking you to do so. Okay, that is the important thing. So, what is a slightly clearer way to use these portfolios? First, define why is it that you are investing in a particular small case. One shouldn't come in with the idea that I'm going to invest in value and momentum model small case, over the next 1 year, and I'll see how it goes. That is not the way it works. Value and momentum model tends to self-select a lot of mid and small cap companies. And if there is a lot of mid and small cap companies, then the investing time frame has to be 4 to 7 year time, period. It cannot be that after a mere 6 months, 8 months, we are judging the strategy and we are attempting to get out of that, right? Uh, so you have to have good understanding of why you are investing in a particular strategy. Then the next thing is what is the time horizon needed for that goal. That is also very important. So overall, the bottom line is the portfolio's role is long-term compounding. It is not generating short-term exceptional returns for us. Our role is to help you stay informed, steady, and be aligned with the process. Give us a chance to do that instead of trying to rush in, trying to time the basket, trying to do something else which is not in the portfolio's best interest. Okay. So overall, this is as far as giving you a lot of uh, context about why the small cases have performed the way they have performed. What sort of mentality is important when it comes to surviving bear markets and so on and so forth. But at the same time, markets come and go. There are going to be good times, there are going to be bad times, and at every single point in time, we at WCPL we are trying to sort of change our process, tweak our process to make things more efficient, so that a lot more time is spent on assessing companies rather than data collection and all other things which is sort of not scalable. So one thing that we've done is we have brought in a lot of AI driven research framework into our processes. We have developed a lot of language and sentiment models. So what these models now do is they are capable of scanning thousands of documents. Now you've seen that we have close to 60 plus small cases, right? So 60 plus small cases, even if each small case has about 10 companies, that is close to 600. Of course, there are not 600 companies in the universe, but there are close to 200, 250 companies at least in the universe. If we have to read through all the annual reports, investor presentation, management, commentary, news, and all of those things, it used to take a lot of time. Now with these language and sentiment models, we are able to do that a lot more quickly. We are able to detect tone shifts, right? If the management commentary is talking about a little bit of crisis in quarter 4, we are able to use our AI models to check to see how that tone shift has been happening. Has it been happening for the better, or has it been happening for the worse? What is the tone in the news articles that have been coming about these companies? So this helps us, instead of deep diving into every single companies, this helps us analysts to prioritize their attention on those companies where the news or the sentiment is not so good, and quickly take a decision on whether we have to retain these companies in the basket or we can drop them out, right? So that is one of the way that we are working with AI. Next one is intelligent summaries. Like I told you, instead of manually scanning through thousands of documents, now we are able to use our AI models to come up with very, very intelligent summaries with clear insights. And these models sort of they tend to highlight what the key drivers are, risks and guidance and stuff like that. Of course, there are clear questions that we have to ask. There is clear context setting that we have to do. But given our experience, we are able to do that, and sort of that is making life a lot more interesting and easy as far as generating these insights is concerned. Third thing that we've done is thematic clustering. Earlier, what used to happen was some company used to get into a niche field or into a slightly adjacent field that they were in, and till the point in time they were able to generate significant revenue out of this niche field or new field, we wouldn't be able to get hold of it, because it would not get reported in their in their annual reports or quarterly presentations or whatever. Now we have started using something called semantic search models, and there is thematic clustering that we are doing, uh, wherein we are looking at all of these management commentaries and stuff like that, and we are able to quickly decipher what is the new area that they are getting into. One of the places where we have extensively used that is the defense AI pick model that we have recently launched. If you have not seen it, you can just check that out. So the core idea is that as far as scalability, as far as speed is concerned, AI does a lot of handling, so that instead of we spending manual hours, hours upon hours of scanning through thousands of documents, we are able to handle the judgment part of it and the discipline part of it, rather than doing the mundane work. That is what has been largely changing as far as WCPL's research process is concerned. Uh, there are a bunch of new small cases that we've launched this year. Take a look at it. Two quant models, like I told you, quality blue chip and growth multi-cap quant. Quality blue chip has been performing really, really well. There are two trackers, capital markets tracker and healthcare tracker. Multiple mutual fund small cases. That this is a new sort of addition that has come out. What we have done is it becomes a lot of times it becomes difficult for people to figure out which one are the best large cap mutual funds or mid cap mutual funds and so on and so forth. So what we've done is we've created these baskets for you. Out of all the large cap mutual funds that are available in the market, we have used our own proprietary models to sort and tell us which ones are the best, whose performance has been the best, and we have put that into a basket for you. So it will work exactly like any other small case. It's just that the underlying, instead of it being stocks, will be, instead of stocks or ETFs, will be mutual funds. Like I told you, the AI specific model, defense picks AI model, just explore that. That is based on the defense theme. Okay. So what's coming in 2026? Most important thing. One, I think market setup. That is sort of like, we are in a reasonably good space. You must all be seeing like, what has been happening to inflation and stuff like that. That's sort of been continuously trending down. There's been a lot of supportive policies also that has come through. There was like, overhauling of GST rates. RBI has also been consistently sort of like, cutting down repo rates and all of these things. So that is the second aspect of it. That is as far as support is concerned. Next, there is sort of like, there's an easing up of fiscal consolidation. So post COVID, what had happened was fiscal deficit of India had really, really surged. And the government was under some pressure to sort of get it under control. And they have been consistently working on that and trying to get the numbers down. And I think the latest numbers were something like 4.4%, which is very close to the 3% benchmark number that they really wanted to be under. So earlier, whatever cutting that they had to do in terms of like, capex spending and all of those things, they have a lot more headroom now. And we can see that in government spending also. Capex has generally been very, very high. So overall, all of these policies are expected to support growth. Uh, FIIs have generally been like extremely underweight on India. All through the year, all through 2024, 2025, and we are hoping that that position will reverse. And one of the counterweight for FIIs have been domestic institutional investors. There's not been any let up as far as SIPs and new investments from Indian mutual funds are concerned. So that is sort of like a good thing. Earnings revival is something that we are all hoping for. Most of the management commentary this time around auto and banks and stuff like that was like quite positive. There was like a lot of positive influence because of GST. Loan growth has banks and NBFCs sort of went through this phase where they had lent out a lot of money to MSMEs and other, not MSMEs, sorry, microfinance companies and other unsecured places, and they had to sort of like clean up their books. But now, like all that cleaning up and all that pressure on the GNPA, everything has eased down a little bit. So hopefully, a lot more lending activity will happen over the next 1 year. So hopefully, all of these things will result in earnings revival. Overweight sectors. Some of the things that we've been seeing based on our commentary so far during the first half is consumption, of course, because of GST related things. And within the broader consumption basket, there are autos, consumer electronics, household appliances, staples, banks and NBFCs, capital markets. Capital markets, by the way, the companies have been generally doing good. Take a look at our capital markets tracker. Internet and telecom services, defense is, of course, the mega theme. So these are some of the sectors that we're sort of overweight on. And what is going to happen as far as Windmill is concerned? There are a couple of new small cases that we continue to work on, something around data centers and the likes. We will continue to see that next year. Uh, Hopefully, we are going to use AI more smartly so that we can keep the expenses low as far as our small cases creating and launching of small cases is concerned. And there are some US based investing and other options that we are sort of exploring over the next year. And hopefully we'll be able to come up with more offerings that are going to be interesting for retail investors in India. So that is as far as the presentation is concerned. Let's take a look at some of the questions. Please, you can use the live chat option and come up with your questions. Rohit, I'm facing tough time after taking House of Tata Small Case last year. Yes, Rohit, the markets have been flat and a lot of sectors. So it works in a double. There's sort of a double whammy, right? One, the markets have been flat. Second, a lot of Tata companies themselves have not been performing really, really well. IT is under pressure. Tata Chemicals is under pressure. Tata Motors has not done really well. Voltas has not really done very well. So, of course, it is working both ways against you. Just hang in there. And hopefully, 2026 is going to be better. Kumar, talk more about the future. I did. I hope you saw that. Please be more crisp. I've used 33 minutes of the time. I don't know how more crisp I can be, Kumar. Bharat Jain, I've subscribed to Windmill Small Cases for the last 4+ years. How do I calculate if the subscription fees plus other fees like small case, SIP, lump sum, etc. If I offset with the profits, don't result in negative. There's a cost calculator, Bharat, that's available within the small case app. On top of that, you can go to the returns dashboard also. If you need any help, just reach out to support@smallcase.com. They can help you with all the minute details, and they can help you understand whether you've made good enough profits or not. Bharat is also asking, there is a minimum SIP which is considered good enough to justify the yearly subscription fees that I pay. I wouldn't look at it in terms of minimum SIP, but overall, it makes sense to get your expense ratio down to about 2 to 3%. So let me just explain that. See, imagine you have a minimum investment amount of a small case at around 1 lakh rupees, and you're paying 10,000 rupees as your subscription fees, right? So 10,000 rupees divided by 1 lakh is 10%. That is your expense ratio as far as that particular small case is concerned. Now, most mutual funds will have anywhere between like 0.5 to 1.5% expense ratio. And ideally, you should look to sort of get your expense ratio down to that level. Because see, on top of this 1 lakh rupees, even if I generate 25% returns for you over the next 1 year, which is like 25,000 rupees, you're giving away 10,000 of that as fees, right? So your net returns is dropping down to just just 15%. So what I suggest you or anybody else who is in your position do is over a period of time, sort of like increase your investment so that the expense ratio sort of starts coming down. Right? If you increase it to 5%, then 10,000 divided by 5 lakh rupees drastically brings down the expense ratio amount. So I hope that makes sense. View on Tata Tech, it has been underperforming Tata small case for a long time. Like once again, I told you, I don't want to jump into individual stocks over here and get into discussions. But generally, what has been happening with House of Tata is there's been poor performance in the market, which is affecting the price performance of the company. On top of that, there are specific companies within the basket who have not performed well. I gave you some examples. So keep both these aspects in mind before you take a call on whether you want to stay invested in the small case or you want to exit it. Just remember one thing about any, like, some of these small cases have gone over to the paid side last year. If you were a legacy user, this free access to this particular small case will continue as long as you stay invested in the, as long as you stay invested in the small case. The moment you completely exit a small case, even if you're a legacy user, you will, if you decide to get back into it, right, you will have to pay a subscription fee. So just keep that in mind before you take a call. Okay. Now, Sridhar is asking difference between, sorry, I don't know, small cases and fee-based small cases. Difference between what small cases? I'm not sure. Okay. Sorry, there's some issue with my phone. I'm not able to see what exactly is the difference you are referring to, Sridhar. I will assume you're talking about, uh, mm, paid small cases and non-paid ones, that is free to access small cases. To be very honest with you, see, whether it is paid or not paid, totally depends on what is the time and effort we have created, we have spent in sort of like, creating some of these small cases. I'll give you an example of Horizon small cases. It is an extremely unique product that's not available anywhere in the market, right? These are our target-based small cases. We had to create a sort of like, we had to create a glide path investing team. We had to do a lot of backtesting to understand what the yearly weights have to be as far as each target year is concerned, what asset classes would work the best, and all of these things. So this takes up a lot of research bandwidth. So based on what is the amount of research bandwidth that goes into creating a particular small case, we take a call on whether it has to be free to access or fee based. So I'm assuming that is what you're asking, and that is what my answer is, Sridhar. So any more questions? We'll just wait. What future prospects for chemical small cases? Chemical small cases, okay. See, because I manage the specialty chemical small case, I'll give you a little bit of context. These companies have been going through some, macro headwinds for about 2 to 3 years time frame now, and the basket has significantly been underperforming. On the domestic side, things have been going really, really well as far as specialty chemical companies are concerned. There have been like there's not a lot of demand had been or margin pressure, but international markets, especially Europe and US, because of the war and various other factors and tariff also this time, there have been headwinds. China has been doing a lot of destocking, which means they've been selling off all their stocks at very, very low prices, which means we are getting priced out of the market. We are not being Indian companies have not been able to sell at the price that they generally do. So all of these factors have sort of been contributing to the poor performance of chemical companies which are in the export mode. Uh, Between that, over the last 2 3 years, they also went through some supply chain issues because of which there were margin pressures and stuff like that. So that also contributed. Now the aspect of margin pressure has eased out. The domestic consumption is good, but we are still seeing some pressure on the international side. Now, having said that, at a company level, all of these companies have been consistently following their management commentary and news and stuff like that. All of these companies have been pretty positive as far as long-term demand, as far as long-term prospects are concerned. Uh, they have been continuing with their capex and all of these things. They have been continuing with their acquisitions. They have been trying to become they have been trying to expand their product base. All of these companies have been consistently doing that. So there might be still some time before they start generating sort of the high returns that they did between 2019 to 2022. There might be still a couple of quarters away from that. But from a long-term perspective, I think the prospects are still bright as far as the sector is concerned. I hope that answers your question. Ideally, how many small cases would you recommend for a long-term investor? I don't think there's an ideal amount. I think Manikiran. Uh, there's not like an ideal number I would go with. See, I usually tend to approach investing from a core and satellite approach. One has to have a core. A solid example of a core would be any portfolio that gives you, uh, that gives you exposure to large cap equities, gold, debt, and a bunch of other asset classes at a very, very low cost, where the expense ratio is very, very low. And then there are satellite small cases, which gives you exposure to specific themes, which gives you exposure to specific asset classes, like let's say small caps and stuff like that. So this is the approach one should take. One could use just timeless asset allocation as a core, and maybe have two small cases, maybe one theme specific, one model specific, and they may be done with it. Somebody else might have might not even go with timeless asset allocation. They might do core investing by themselves and come to small case platform only for specific satellites that they like to invest in. So I don't think there's an ideal number here. That's what it is. From the previous live stream, you educated us quarterly rebalancing is good, but all I see is new small cases are monthly rebalancing. No, 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 no. So let me clarify over here. See, when we create a small case, I'll give you an example of value and momentum and quality small cap quant, right? So the question is not whether quarterly rebalancing is good or monthly rebalancing is good. One cannot come up with a blanket statement like that. The question is, as far as both these models are concerned, what we do is when we sort of conceive these strategies, right? When we think that okay, maybe value plus momentum would be a very good bet, we go out and do extensive back testing. When we do back testing, we check it on multiple rebalance strategies. We do annual rebalancing, we do semi-annual rebalancing, we do quarterly rebalancing, we do monthly rebalancing, and all of these things. So what would have happened is value and momentum on a quarterly basis would have generated maximum returns when you do back testing, right? Historical back testing. Very similarly, when it comes to quality small cap quant, what we would have figured out is we would have done a lot of permutations and combinations, and we would have figured out that monthly rebalancing works best as far as that particular strategy is concerned. So it's not just a question of okay, whether quarterly rebalancing is good or whether monthly rebalancing is good. It is a question of context. As far as this particular small case is concerned, is quarterly rebalance good or is monthly rebalancing good? So the new ones that we have launched, it's just by accident it has happened that what we've realized is, as far as those strategies are concerned, monthly rebalancing is good. It is not a hard and fast truth. If you look at our capital markets tracker and healthcare tracker, we're doing quarterly rebalancing over there. So completely depends on the strategy. Nothing to do with blanket statements. But that's a good observation, Kiran. I'm happy that you've been attending our sessions, and you've been following what we've been saying. Okay. I think we've spent a good 45 minutes. That's pretty much it from our end. We'll stop here. Please do continue to read into our newsletters and stuff like that. We've been putting out a lot of manager updates about individual companies and sectors. Please do follow them as well. That will help you get a little more context about in real time what is happening about the strategy and the likes. And hopefully we'll meet you next year once again. We will come up with new small cases, a little more update about the market, and hope the markets are going to bring us good tidings next year. Thanks everybody for joining in. Thanks a lot.